A very good morning, friends. So I hope you are all doing well. The weather these days, of course, is a monsoon type, a very interesting one. And so are the standards what we are doing these days. So last time we had a discussion with reference to Ind AS 103, that is business combination, and that laid down the foundations in terms of the consolidation standards. So today, as well as in the next session, we're going to carry on the trail of the consolidation standards with you. Today, our focus is on one of the very important standards from the examination point of view, and that is Ind AS 110, which talks of consolidated financial statements. Well, I hope that you've already watched the lectures, which are the detailed lectures on consolidation, because what we're going to do today is the main key points in that particular standard. We've already spent a good time in terms of doing the consolidation standard Ind AS 110. Now, we know that when you look at the concept of Ind AS 110, when does that standard trigger? It is when an investor gets a control over the investee, then we say, yes, he is required to make a consolidated financial statements. So I think just let's first get the very basics clear before we go on to the advanced level of the standard. So what comes at the very start of the mind is when we look at Ind AS 110. The name of the standard is CFS, that is Consolidated Financial Statements. Now, the very first thing what comes to the mind is when you look at the standard Ind AS 110, and that is, let's say there is a company A Limited and there is a company B Limited, and A Limited makes an investment in B, or I would say that you are able to establish that A gets a control over the business of B. Now, when we say that A gets a control over the business of B, control, remember, is not a rule-based assessment under Ind AS 110. So the main focus point, what you need to keep in mind is that when you're looking at the control assessment, it is not a rule-based assessment. It is not a rule-based assessment. It is supposed to be a principle-based assessment. So we know that there are three factors which will determine. So it is a principle-based assessment on the basis of which we decide whether the control is established or not. We will be talking in terms of the principle, the three major principles which are laid down in the standard, which defines when does A control the business of B. But before I think we come to those particular aspects, we also need to keep in mind, once you establish that A controls the business of B, A is supposed to be called as a parent company. Or we can also call it as a holding company. And as far as B is concerned, B is supposed to be called as a subsidiary company. So once we establish the relationship of control, that means A controls the business of B, we can clearly establish that in this case, A is the parent or the holding company and B is supposed to be the investee, that is called the subsidiary company. And Ind AS 110 mandates A Limited. So mind the words I said, Ind AS 110, you can say mandates A Limited. He is mandated, so that means it becomes mandatory for A Limited in order to prepare and present a consolidated financial statements. Rather, I would say that A Limited is required to present two financial statements year by year. So it is mandatory in terms of A Limited that he is going to present two financial statements. One is called a separate financials and one is called a consolidated financials. So we've already seen last time that when A establishes a control over B, there is a one-time application of Ind AS 103. You apply Ind AS 103 only on the date of acquisition. It's a one-time application of the standard. But when it comes to year by year, A is required to make two sets of financial statements. One is a standalone, but we don't call it as a standalone. We call it as a separate financial statements prepared under Ind AS 27. And a consolidated financial statements, which is prepared under Ind AS 110. So the separate financial statements is prepared year by year as per Ind AS 27. and the consolidated financial statements are prepared year by year as per Ind AS 110. So let's take a quick summary in terms of what we have discussed so far. Nothing technical, just a little basic background on the standard. So we said the two things what you need to keep in mind so far when A establishes a control over the business of B. The control is not a rule-based assessment. We cannot say that if A gets more than 50% voting power in B, that would establish a control. It is based on certain principle, and these principles are three principles which we'll discuss later. So which means we cannot preclude the possibility that A could control B even if he's got less than 50% stake in B. We cannot preclude the possibility that A may not control B even if he's got more than 50% stake in a company. So the percentage is not a criteria, but it is a principle-based assessment. That is one aspect. I guess if we look at the examination, I think there's not been much weightage at times in terms of making an assessment. But I think in RTP, once there was a comprehensive case study, and I think now since you are going to get MCQs as well, you need to be carefully clear, because in MCQs you could get, smaller parts in terms of assessment of control as well. So one of my key focus points of discussions in this standard is the assessment of control. How does this principle-based assessment tell you that there is a control? That is one thing which we've learned. Second, once you establish that A controls the business of B, then in this particular case, it is mandatory on the part of A. That means he is required on a mandatory basis to prepare two set of financial statements year by year. One is a separate financials as per Ind AS 27, in which he would reflect the investment in B using a cost or a fair value, which is an accounting policy choice. And the other one is Ind AS 110, in which he is required to present consolidated financial statements year by year. My focus, of course, today is the consolidated financial statements. But now another question comes before we discuss the concept of control assessment. Are there any kind of exemptions or exceptions which are given in Ind AS 110, which tells me that even if there is a control, I am not required to present a consolidated financials? The answer is yes. Now you must have seen that I very carefully use the word exemptions and exceptions. Because when you say it is exempt, that means I am giving a choice to the parent company. You want to consolidate or not, you've got a choice. And when I look at exceptions, then in those cases, I'm mandating the parent company, you cannot prepare a consolidated financials. So I'm going to first of all, bring out very quickly the two categories. One is where the parent company is told that you've got a choice. You want to present console or not, it's a pure choice. You want to, you can. You don't want to, you may not. And the other area is where I'm telling the parent company A, boss, you cannot prepare a consolidated financial statements. So before the control assessment, let's have a quick look in terms of these exemptions and exceptions available in terms of consolidation. So let's take the journey forward. So we're looking at the case that making consolidated financial statements is mandatory, but we're looking at is there any exemptions or is there any exceptions where a company is not required to make a consolidated financial statements in spite of the fact that you are establishing a control. So let's, I think, go back and have a look at what does the standard says on this parameter. Now, when I'm looking in terms of the area where the standard gives you a choice to consolidate or not, trust me, this particular choice is going to apply only in terms of chain holding. So which means when I'm looking at where the parent company gets a choice, one of the most key important factors is this will apply only when it is a case of a chain holding. You will not see a normal situation where a parent company gets a choice of consolidation. For a choice of consolidation, one of the most important parameters is that there is a chain. A chain would mean, let's say, for example, there is a company A there is a company B and there is a company C. Let's say A controls B and B controls C, so we can clearly see that there is a chain. The para number 4 of Ind AS 110, gives me insight in terms of when does a parent gets a choice. And remember, the para number 4, which gives you a choice, this choice is available only to the middle company. This choice in terms of para number 4 is available only to the middle company. In a chain holding, as far as A is concerned, he cannot avail the case of choices. In a chain holding, remember, it's only the middle company. Right now, my chain is pretty short because I've taken A, B, C. The chain could be even longer. Then you can say any intermediate companies in between could get this choice under para number 4. But this middle company, when it gets a choice, there are a total of 4 conditions which you need to fulfill. And you need to fulfill all the 4 conditions, only then you get a choice. So let's have a look at what are these 4 conditions on the basis of which the middle company gets a choice to consolidate or not. So if we look at the 4 conditions which are there in the standard, it very clearly brings out. Let me just pinpoint quickly. And in short, what are the 4 conditions which B needs to meet before he gets a choice? The condition number 1 is that we need to prove, first of all, that B is 100% wholly owned subsidiary of A. But if B is not a wholly owned subsidiary of A, then that means some shares are held by outsiders, that is called NCI, non-controlling interest, in which case B needs to get an NOC from the NCI, mind the words. So I'm saying that there are a total of, one of the 2 conditions in condition 1. There are 2 situations in condition number 1. Either you prove it to me that B is a wholly owned subsidiary of A. So either I say that A is got, let's say, 100% stake in B, then the condition 1 is met. If you say that A has got 100% stake in B, which proves that B is a wholly owned subsidiary of A, the condition 1 is met. Or the other situation can be that, let's say, A has got less than 100%. So it is less than 100% stake in B. Well, if A has got less than 100% stake in B, then there is some stake which is there with the NCI, and you need to get a no objection certificate. So don't take it literally that I need a NOC, a certificate, but I need to get the, you can say, the consent of the NCI that if B does not prepare a console, then the shareholders, the other shareholders of B don't have a problem. So we need to basically, in this particular case, you can say get an NOC from the NCI. So let's say if A has got 80% stake in terms of B, the 20% stake is held by somebody who is outsider, then in this particular case, B needs to go to those outsiders NCI and tell them that I am not wanting to consolidate C Limited, and just tell me that you've got no objection if I don't present a consolidated financial. So that is condition number 1, that A has got 100% stake in B, condition met. Or A is got less than 100% stake in B, you get an NOC from the other stakeholders of B. The second condition, we need to basically prove in this particular case that B is not listed. So we need to prove in this particular case that B is not listed. I guess that is one of the very important inputs given in the standard, because we need to understand that there is no public interest in this entity. If this company is not listed, then nobody is publicly interested in this particular company. So I think this is one of the most important conditions, that B is not a listed company. And we should also prove that B is not potentially listed as well. So B is not potentially listed as well. That means he is neither in the process of getting listed as well. Neither he is listed, that is one, nor he is in the process of getting listed, which means there is no public interest involved in terms of B. Because if it is not listed or not in the process of getting listed, then the public interest in such company is not there. Then we don't mind if it does not prepare a consolidated financials. And then another condition what we need to look into out here is, We need to prove that any, you can say the ultimate parent, or we can say any intermediary parent. The ultimate or the intermediate parent presents consolidated financial statements as per Ind AS for public use. So it is preparing a consolidated financial statements as per Ind AS for public use. I did not write public use, but that's also important. So I would say there are two inputs. The ultimate parent, in this case, the ultimate parent of B is supposed to be A. The chain could be longer, so you can say the ultimate parent could be on the top or any intermediate parent above B. So we need to prove that, any ultimate parent or intermediate parent is presenting consolidated financials as per Ind AS for public use. That's the two important inputs. You're making a consolidation as per Ind AS and you're making it for public use as well. So if all these four conditions are met, I would give a choice to B that you want to present a console, a B and C, you can. You don't want to present a console, it's a choice. So I hope I'm pretty much clear in terms of the case where the parent company gets a choice. It is not mandatory. Let me repeat once again that B is being given a pure choice. You want to present a console, you can. You don't want to present a console, you may not. No force. So quickly, just quickly remind the four conditions with us. So the first thing what you need to remember, the concept of choice comes in a chain holding. And I think if you forget to remember C for choice and C for chain holding. That's an easy way of putting things, that you need to consider that this is a chain, a C, where you get a choice, that is C. So CC is the case where you get a choice. This is a case of para number 4, where the middle company is going to get a choice of consolidation if all the four conditions are met. You prove it to me that A has got 100% stake in B, or you prove it to me that if A has got less than 100% stake in B, then you've got an NOC from the NCI. They don't object for not presenting console. B is not listed, B is not in the process of listing, and any ultimate parent or any intermediate parent in the chain is presenting consolidated financials as per Ind AS for public use. And this particular case, we will tell B, you get a choice. Simple and straight. I guess that should be pretty clear indeed. I think so. Yes. Let's now go on to the second situation. So this was a case where we are giving a choice to B. Now the other one is where we are saying that there is a mandatory situation. So when you say that there is a mandatory situation, we are telling the parent company you cannot make a consolidated financials. It's a not matter of choice. So mandatory situation would mean that we are telling the parent company you cannot prepare a consolidated financial statements. So this is a mandatory situation where we are telling the parent you cannot make a consolidated financial statement. Now, this kind of a situation can arise either in a chain holding or even in terms of a non-chain holding. So in order to give you these steps, I think what I'm going to do, I'm going to give you a very simple example, and I'm going to give you a 3-step model with the help of which you can easily identify whether the consolidation would take place or not. Let's have a look. So let's give you a 3-step model in which we will be able to decide whether we are mandating the subsidiary company to make a console or not. So let's consider a simple case without chain holding. Let's consider there is a company A and there is a company B. And let's consider A has got a control in terms of company B. Now, in this 3-step model, I am going to put some sequential input steps to myself. The step number 1 is what you need to ask yourself is that is A Limited an investment entity? So this is a particular case which is involving an investment entity. So you can say for this particular mandatory situation of not consolidating, what is important is that it should be a case of investment entity. The parent needs to be an investment entity. Otherwise, this particular situations cannot trigger. In the previous one, there was no such inputs in terms of looking at that, the parent is investment entity. So this is specific in nature. So you need to first of all see that is A Limited an investment entity, and you know already that as far as an investment entity is concerned, there are a lot of characteristics. There are a lot of characteristics, as well as you can say the definition parameters which you need to meet before you call it as an investment entity. So I think I'll not get into those definitions, the definition parameters and the characteristics, but in nutshell, there are like 3 definition and 4 characteristics when you classify an entity to be an investment entity. In short, we can say this entity is established with the objective of earning, you can say, dividend interest income and a capital appreciation, something similar to an investment property. When a company makes a property investment in a property, the objective is a rental income and a capital appreciation. So this would be a company which is taking money from more than one investors, making more than one investments with, they've taken money from unrelated investors, and they're parking this money in terms of various companies so that they can give a lot of capital appreciations and returnable and return income, interest and dividend income on the portfolio. So the objective of this investment entity is to do benefit for the investor. Take money from one or more investors, channelize that money in one or more investments with the pure objective of getting a capital appreciations and you can say income in the form of interest and dividends as well. But at the same time, there are more characteristics also coming in. Like, for example, this investment entity should have an exit clause in terms of taking the money out of those companies, investee companies in which they've invested. So because exit clause is one of the most important clauses before we can say it's an investment entity. Now, once you say that yes, A Limited is an investment entity, or you say no, it is not an investment entity. So either the answer is a yes or the answer becomes a no. Now, if you say yes, it is an investment entity, we will go to step number 2. And if you say no, it's not an investment entity, then consolidated financials are going to be prepared. Then you do not get any kind of exception. So the moment the parent company is not an investment entity, you do not get any choice, any exceptions. In this case, you are mandated to make a consolidated financials. Now, the second step is once you say that is A an investment entity, we say is B Limited, the subsidiary company. Is B Limited an investment entity? I'm putting it as IE, that is investment entity. So let's put it out here. This is IE, investment entity. Now, the parameters, of course, would remain the same in terms of identifying whether B is an investment entity or not. So here again, you could reach a conclusion, yes, it is investment entity, or no, it is not an investment entity. So if you say, yes, it is an investment entity, then the consolidated financials are not required to be prepared. So I think one thing very simple indeed, if the parent and the subsidiary are investment entity, you are told clearly that A cannot make a consolidated financial. So get this clear. If the parent company A is investment, B is investment entity, then I tell A, you don't have a choice. You cannot make a consolidated financial statements. Now, if you say that B is not an investment entity, you got to go to the step number 3 in this particular case. So let's see what is step number 3. Now, once you've identified that B is not an investment entity, you go to the step number 3. Now it is time to see what is the activities of B. What kind of activity does he do? Is his business activities similar to A, or is the business activities not similar to A? So we need to see that is the business activities. So we can say is the business activities of B Limited similar to A Limited? It is similar to A Limited or not. So there is a very interesting case study which is given in terms of the study material as well, that one of the questions is there in the education material also, which gives you an insight in terms of both the mandatory and the choice kind of exemptions. So we need to see that is B limited activity similar to that of A limited. So we can say, yes, they are similar, or we can say, no, they are not similar. I know a small question would also come at this stage. You would say that if B is not an investment entity, how come the activities of B are similar to A? Well, I can only say that, the conditions, the parameters which are required to prove that B Limited is an investment entity is very stringent indeed. Because you've got a total of 7 parameters, 3 definition and 4 characteristics which you need to meet. So out of those 7 conditions, even if you fail any one of them, you do not become an investment entity. So there is a possibility that, as far as B is concerned, he is got quite similar characteristics of an investment entity, but fails to meet all the 7 parameters which are there. And therefore, it does not become a investment entity. But still, the work which he is doing is quite similar in terms of A. So when B is not an investment entity, but the work which he does is quite similar to A Limited. So if you get the answer yes, consolidated financial statements in this particular case is required to be done. Is required to be done. It's like apples and apples being consolidated. A is doing something, what B is also doing. The B is not an investment entity. So in this particular cases, the nature of the activities is similar. Consolidation makes sense. But if you say, no, it's not similar in nature, then consolidated financials would not be required. It would be consolidating apples and oranges in that case. So moral of the story that when you look at the 3-step model, the parent is investment 1. The subsidiary is not investment 2. But the nature of the business is similar to that of the parent. Consolidation becomes mandatory. So there are a total of 3 situations which comes out of the 3-step model. A is investment entity, B is investment entity, no consolidation. A is investment entity, B is investment entity, and B does something different from A, no consolidation. Number 3, A is an investment entity, B is not an investment entity, and B does something which is similar to A, consolidation will take place. So that is the inputs in terms of the 3-step models which are there. So I think let's have a very quick look at the inputs, what we have learned so far on the first phase of a discussion. So what I've basically given you is that when you say that a company, an investor establishes a control over the investee, remember there are 2 broad situations. One is where we tell the parent, you get a choice not to consolidate. And the other one, we tell him that, boss, you cannot consolidate. So the para number 4 is focusing in terms of the situation when you are telling the parent you get a choice. There are 4 conditions. If all those 4 conditions are met, you give a choice to the parent company. You want to, you don't want to consolidate, your choice. The second situation comes in when you start looking at the case when the parent is an investment entity. So the thought process is parent is investment, subsidiary is not investment, but the work which the subsidiary does is similar to A. Then consolidation will be required, not in other combination. So remember, the key input is parent is investment, the subsidiary is not an investment, and he does something which is similar to A, then we tell A Limited that you need to consolidate. In other cases, we will tell A that you cannot consolidate in this case. Right, so far so good. I hope I am pretty clear so far at this stage. Let me see any questions coming in. All good to go. So this is the first stage of a discussion. Now let's focus in terms of the control assessment with you. This was the first area of discussions. And now let's come to, I've also done a detailed question with reference to one of the questions which I said is in the education material. So do look at that detailed video where we've also discussed that questions. We've done some good number of questions explaining the nitty-gritties in terms of how do you decide it is exempt or it is getting exceptions. Since we've got one class, I'm not getting into all those detailed examples at this stage. Let's go to the focus number 2, that is control assessment. The second focus is in terms of control assessment. Now, I think I've already made a clear-cut mention that as far as control assessment is concerned, it is supposed to be something which is a principle-based assessment. It is not something which is a rule-based assessment. The control assessment in this particular case in the standard is a principle-based assessment. And here again, I'm going to give you a simple three-step model, remembering the key aspects of those three-step model, what you need to see. Detailed examples we have covered later, but covered them in the detailed lectures. But let's get the overall, first of all, framework in mind. So when you're looking at the control assessment, it is going to be a simple three-step model again. So I would say step number one, which has got three sub-steps ABC. Then there is a step number two, and then there is a step number three, which will help us to identify the control. Now, in terms of step number one, I would say in terms of step number one, we need to look at the concept of power. We need to see that does the investor have a power over the investee? And in terms of looking at the power, there are three sub-steps which you need to look at in order to identify that does the investor exercise a power over the investee. So when I'm looking at does the investor exercise a power over the investee, we're going to look at three elements. One is what I call ER, that is existing rights. ER, that is what I call existing rights. And then I call it as CA, that is called a current ability. That is called a current ability. And the third one is what I call RA, that is called relevant activities. That is called relevant activities. So you can say power is supposed to be a blend of three factors. When you're looking at the assessment of power, I would say power has got three aspects. One is existing rights, ER, current ability, CA, and the relevant activities, that is RA. So we'll make a walkthrough on each one of them, but you need to keep in mind that when you look at the concept of power, all these three elements in terms of power need to be present. Once you've said, yes, there is a power, we go to the second part and we say that the investor is got exposure to variable returns. So we need to consider that as far as the investor is concerned, he's got exposure to variable return. Well, generally, if an investor is got ordinary shares in the investee, I think it's not difficult to prove that he is definitely exposed to variable returns because he's getting dividends. And the dividend which he gets from the company is definitely an exposure to variable returns. The company may earn profits but may not give him dividends. The company is not obliged to pay dividends, so the investor is definitely getting exposed to variable returns, but there is more inputs coming in. So once you establish the step number one and two, then what you need to do, you need to see that there is a linkage. The step number three is looking at the linkage in terms of power and the exposure to variable return. And here the job is pretty simple and straight indeed. If you say that, yes, there is a power and yes, I am exposed to variable returns, we can directly say, yes, the linkage is there. If you say, yes, there is a power, but you're not exposed to variable returns, the linkage automatically does not get established. Which means the third step is not a very crucial step indeed. If in step one you say, yes, you've got power, in step two you say, yes, you're exposed to variable return, the step three automatically is a yes. So any of the two steps would fail, the linkage will not get developed. So if you say yes to the step one and yes to the step two, only then the linkage is going to take place. So our focus is going to be in terms of step one and in terms of step two, because linkage automatically is going to get developed in this case. So let's make a little more extensive discussions on the concept of power and exposure to variable returns. So let me come on to the discussion now as far as power is concerned. We'll go step by step. So let's focus in terms of step number one, that is the concept of power. And I've already given you the inputs that power has got a total of three elements to be evaluated. Number one, we are looking at existing rights. Number two, we are looking at current ability. And number three, we are looking at relevant activities. So I'm putting it as ERCA as well as the concept of RA. Now, let's, I think, first focus on the concept of what are relevant activities. I would say any activities which could, influence the profitability, which could impact the returns of the investee. So any activities, I would say any activities, which could impact the returns, which could impact the returns of investee. So as an investor, I am in a position to take decisions on these activity. Mind the words. As an investor, I am in a position to take decisions on these activities which could impact the returns of the investee, be it fixation of selling price, be it managing the financial assets of the company, like looking at the business model, and be it purchase of the fixed assets of the company. There are certain examples which are given in the standard in the Appendix B of Ind AS 110, which tells you a few examples, illustrative examples, not exhaustive examples, which expose you that if these particular, these examples are fit in, they're relevant activities in nature. But in a nutshell, we can say that as an investor, I should definitely be in a position to take decisions on those activities which could impact the returns of the investee. So if I'm in a position to take decisions on those activities which could impact the returns of the investee, certainly it is relevant activities in nature. So just to pinpoint, as I said, the standard has given an illustrative list. If you look at the Appendix B, there is an illustrative list which is given in the standard Appendix B of the standard. If you want to look at that list, you can have a look at what are those examples given. Okay, because when you get an MCQ, you could also be given certain activities, and they tell you that which one is a relevant activity. So I think a little knowledge in terms of the examples on relevant activities could be important, at least from a small MCQ perspective. Next, let's come to the aspect what is current ability before we come to ER. Now, when you look at the concept of a current ability, what comes to the mind is the current ability means as of now, currently. Do you got the ability as of now? There is current ability, but I would say current ability means when need arises. I would say the current ability means when the need arises. So we're looking at that as an investor, do you have certain rights as of now? When I say existing right, these means that you've got rights as of now. So do you have some existing rights as of now, which will give you the ability when the need arises? So when I say when the need arises, which means that let's say there is going to be a meeting which will take place after 30 days time. And I know that decisions on relevant activity is going to be taken 30 days later. Will I be in a position as an investor to take decisions after that 30 days when the meeting takes place? So my assessment of the power is not based on as of today. I need to be a futuristic in nature. I need to see when the meeting is going to take place at that particular stage after 30 days when the meeting will take place. As an investor, will I be in a position to exert my power or not? So when I say current ability, it means when the need arises in this case. There are a couple of examples which are given in terms of the standard which illustrates that whether there is a current ability or not. Just to give you very quick inputs on certain example. It is not necessary that I already have majority shares in a company. It is quite possible that as of today, I've got no shares in the company, but I may be a party to a forward contract where I might be acquiring the majority shares in a company at a later date. Or let's say, for example, I don't have majority shares in a company, but I am a party to an option contract where I might be acquiring majority shares at a later date. It doesn't make a difference. If you're a party to a forward contract or if you're a party to an option contract where you are going to acquire a majority shares at a later date, it is definitely an existing right. What is important is, let's tell you that. What is important is, let's say, I think I'll divide this in two sections based on the examples. So I think based on the examples, I will simply divide this in two broad cases, or rather three broad cases. If you look at the detailed lectures, I have covered the different permutation combinations out there. But I think I'm just going to quickly give you the insights in terms of the three permutation combination. Let's say as an investor, you already have majority voting rights. I would say unless there is anything to the contrary, I have reasons to believe that if you've got majority voting rights in a company, then you definitely have got power. So if there is nothing given to the contrary, as an investor, I have a majority shares in the investee. I presume, yes, I have got a power. Second, let's say you are a party to a forward contract where you are yet to acquire majority shares. I don't have any shares as of now. As an investor, I don't have any shares as of now, but I am a party to a forward contract where I will be acquiring majority shares at a later date. So all you need to see in this particular case is that if you are a party to the forward contract, you just need to see whether the contract will be, you can say concluded before meeting. So whether it'll be settled before the scheduled meeting or not. So the only inputs to be seen in this particular case is that if you're a party to a forward contract, will you be able to acquire those majority shares before the meeting takes place? So let's say, for example, I am a party to a forward contract. The meeting is in the next 30 days. My forward contract is going to settle in the next 25 days. So by the 25 days of expiry, I will get majority shares. And when the meeting takes place, I will be able to get a majority shares and exert my power. The third situation is that, you may be a party to an option contract. You may be a party to an option contract. Now, we also need to get a very clear-cut distinction that when you're looking at a forward contract, which means that if you have entered into the contract, you cannot escape. You need to honor the contract irrespective. A forward contract is something where there is no exit. If as a party to the contract, if you enter into the forward contract, you need to honor the contract irrespective. But when you enter into an option contract, you get a choice. You may exercise or you may not exercise. So what is important in terms of an option contract to establish a current ability is, number one, it should be deeply in money. The first aspect is that it should be deeply in money. Because if it is, let's say, in at out money, you cannot be certain that you will exercise. When you say it is in money, you cannot say that yes, you will exercise. Or if it is at money, you cannot say that I may or may not exercise. It becomes more subjective in nature. So the only situation where you can certainly say that yes, I will exercise those options is when those options are deeply in money, and this is also going to be settled before meeting. So there will be two inputs which you need to evaluate in terms of option contract. I'm just giving you a crux of those examples which we have covered in the detailed lectures. So if you want to get a more deeper insight in terms of things, look at those detailed lectures where I've taken examples which are given in the appendix of the standard, which gives you the permutation combinations of all what I mentioned at this stage. So we can say that when you're looking at the concept of power and when you're looking at the current ability, you are sitting as of today and trying to make an assessment that once the meeting takes place in which decisions on relevant activities will be taken, will you be in a position to exercise the power or not? So I repeat it again, the most important aspect is you're sitting as of today and you're saying that the meeting is yet to take place after 30 days time. So will I be in a position to exercise my power when the meeting takes place? So when the need arises, when the meeting takes place. If you've got majority voting rights, I think it definitely implies, yes, you will be able to exercise power. If you're a party to a forward contract, we just need to prove that that forward contract will settle before the meeting date. And if you're a party to the option contract, you need to prove two things. Number one, it is deeply in money. And number two, it will settle before the meeting date itself. Because forward contracts, you don't need to see whether you will exercise or not, because forward contracts have to be exercised. So the only parameter is the timing factor of the meeting. But in terms of the option contract, you need to see the status of whether you will exercise or not, and also the status whether it is going to be settled at what point of time. So that was on the current ability part. Now let's go to the next part, and we're looking at existing rights. And I think I want to expand this further. I want to take some more details on the aspect of the existing rights. How are we going to look at the existing rights? So there are a lot of permutation combinations which are given in the standard as far as existing rights are concerned. So let's go to the fresh chart in terms of existing rights. So I'm looking at the first element in terms of power, that is called existing rights. I'm just trying to condense the features, which you need to make an assessment in terms of control, because we've got a lot of things to do today. Because apart from the control assessment, I need to make a walkthrough in terms of how the consolidation is done, what are the various steps which will be there, and if time permits, we'll do a little practical illustration, or otherwise I'll perhaps do a situation whereas the control is gone or the control is not gone. So what happens on further acquisitions and disposals? So I think that's another very interesting aspect in terms of 110. A lot of things to go. Okay, so when we're looking in terms of the existing rights, I would say there are two permutation combinations which could arise in terms of existing rights. Your existing rights could be in the form of voting power, or your existing rights could be in the form of appointment and removal of the KMP. So the standard makes it clear that there are basically two kinds of rights which we are looking at. One is, you can say, the voting rights. So one is called the voting rights, and the other one is what we call the right to appoint and remove. The right to appoint and remove KMP. So this is another form of right, that is the right to appoint and remove the key management personnel of the company. So let me first make it very clear that either of these rights need to be present in order to assess the concept of power, indirectly, of course, the concept of control. But it is very difficult that as an investor, if you've got no voting rights, it will be difficult to establish the concept of power just based on the right to appoint and remove a KMP. So I think the emphasis, even in a practical life scenario, is not exactly on the concept of right to appoint and remove KMP. This is, more like an additional right which you may have. So at the end of the day, I think the major focus comes on that you've got voting rights. So though this is and or, though if you look at the standard, it is a case of and or, you've got voting rights along with the right to appoint, remove KMP, or maybe just one of them. Now, when you look at the concept of voting rights, we've got various permutation combinations coming in. So when you look at the concept of voting rights, I would say broadly there are two kinds of situations which could arise. I've got majority voting rights, or I've got, as an investor, less than majority voting rights. So there are going to be two situations. You have majority voting rights. So we've got majority voting rights, putting it as VR, or you've got less than majority voting rights. So when you say that you've got majority voting rights, I would say there are two permutation combinations arising here as well. So when you say that there are majority voting rights, there are two situations which will further stem in. As an investor, you've got majority voting rights and you've got power. As an investor, you've got majority voting rights, but you don't have power. So there are two situations. You've got majority voting rights, and I say, yes, you've got power. And I say, you've got majority voting rights, but no, you do not have a power. Now, the question arises, how would that happen that you've got majority voting rights and still you say that I do not have a power? Sometimes The voting rights are going to be exercised based on approval by regulatory authorities or based on the court. The court or the court approval or the regulatory authorities approvals are required before you exercise your majority voting right. So I have got majority voting rights as an investor, but I cannot exercise those voting rights unless I take a court approval or unless I am taken some regulatory approval. If every time I need to take a permission, I always tell people, may I go to drink water? So in those particular cases, you cannot get a power. So this particular case will arise when your power is subject to, you can say, approval. If your power is subject to approval, in this particular case, it is difficult to establish the concept of power. So one of the combination is you've got majority rights. Yes, you've got a power. You've got majority rights, and no, you don't have a power. Because in this particular case, every time you exercise the rights, you need approval from the court. You need approval from the regulatory authority. The interesting parts comes in when the investor has got less than majority voting rights. In this particular cases, you can have a lot of permutation combinations. So you can have a lot of permutation combinations in this particular case when the investor has got less than majority voting rights. Now, you've got less than majority voting rights, and along with this, you've got potential voting rights. So you've got less than majority voting rights and you've got potential voting rights, convertible debentures in a company, which if converted will give you power. Or let's say you've got convertible preference shares or any kind of potential ordinary shares, I would say. If you've got as an investor ordinary shares below 50 and you've got potential ordinary shares, then you need to again make an assessment whether as an investor you are going to exercise those potential voting rights or not. You need to make an assessment that as an investor, would you be exercising those potential voting rights or not? So if you say that, yes, these potential voting rights are deeply in money, then the possibility is, yes, you would exercise them and this could give you a power. And when you look at the potential voting rights, you need to look at the potential voting rights of as an investor. And you should also look into the potential voting rights of other investors as well. Because the other investors' potential voting rights may snatch away your power. Or the potential voting rights which you've got may, you may snatch away the power of somebody else. So you need to look at the potential voting rights of yourself as an investor and on the other investors as well. Second permutation combination could be less than majority voting rights and there is a CA, a contractual arrangement. Along with the fact that you've got less than majority voting rights, there is a contractual arrangement as well. The contractual arrangement means that you've entered into an arrangement with someone, some other investors, that you're going to act jointly. So let's say you've got a 40% stake in the company and another 20% stake belongs to another investor. You club them and it makes it 60%. So together you get majority voting rights. As a standalone investor, you've got below 50. But when you consider the contractual arrangement with another investor, it gives you a confirmed power in this case. A case of potential voting rights may not be a confirmed case of power, but when there is a contractual arrangement, I would say, yes, it is definitely a case of a confirmed, you can say, power. The third combination which could arise is that along with the less than majority voting rights, you also get the right to appoint the KMP as well. It's a blended dual kind of a right. On one hand, you've got less than majority voting shares, but also the right to appoint and remove KMP. This again is something which needs to be assessed. You cannot say on a confirmed basis that you will definitely get a power in this case. Because it all depends upon that your right to appoint or remove the KMP can be snatched away by the other investors or not. If I have this particular right and I know that nobody else can take away this right from me, then yes, I could possibly prove a power. So it is again subjective, depends upon the facts of the case. The fourth combination is that I don't have anything else. I only have less than majority voting rights and I don't have anything else. But my relative size compared to the other investors is much bigger. My absolute percentage is below 50, but when I compare myself with the other investors, my relative size compared to the other investors is pretty high. So I might be the single largest shareholder of the company without majority voting rights, but that can still give me a power as well. So in this particular cases also, it could be subjective. You can't really say that every time a single shareholder of the company, which has got a major number of shares below 50, is going to get power. You need to see how active the other shareholders are, how widely dispersed the other shareholders are. So that is again a subjective assessment. Or it could be a mix of any of these permutation combinations, which can be very subjective indeed. And of course, there are no examples on that area. So this is as far as the concept of ER is concerned. I think we need to consolidate the inputs in terms of power. Having understood ER, CA, as well as the concept of RA, let's first consolidate the picture to get the complete input on the concept of power. We're still on step one, we're not on the step number two. So let's, I think, take a quick recap in terms of things. When you're looking in terms of the concept of control assessment, I very clearly said that Ind AS 110 is not supposed to be a rule-based assessment. It is not the percentage more than 50 which will decide the state of control, but it is a subjective, a principle-based assessment. You may get a control if you've got majority shares. You may not get a control if you've got less than majority shares, more than majority shares. You may still get a control if you've got less than majority. It's all a principle-based assessment. So when you're looking at the assessment of control, there are three factors which goes on the assessment of control. One is power, one is exposure to variable returns, and one is the linkage between the step one and step two. And step three doesn't need much inputs. If you say you've got power, and if you say you're exposed to variable returns, there it goes, yes, you've got control. So if you say no to any step one or two, the linkage cannot arise, the power cannot arise, the control cannot arise. Now, coming to the concept of power, you've got three inputs. ER, you've got some existing rights, and current ability, CA, and there is RA, relevant activities. In a nutshell, what do you want to prove? You've got certain existing rights as of today, maybe in the form of majority shares, or maybe as a party to a forward contract, or maybe as a party to an option contract, which will give you the power to exert, take decisions when the need arises. Mind the words. You've got certain existing rights today, and these existing rights will give you, put you in a position to take decisions when the need arises, and this will be to take decisions on relevant activity. So the focus in terms of power is that I need to see that you've got some rights as of today, which will be, giving you a position to take decisions when the need arises, and those decisions have to be pertaining to relevant activity. So when you look at the list of relevant activity, I said the standard is given a certain list of illustrative list of relevant activity. But the nutshell is that all those relevant activities are those activities where you can say that they will impact the return of the investee. So as an investor, if I am in a position to take decisions on those kind of activities, which could influence, impact the returns, the profits of the investee, I am certainly going to be in power. So then we saw that what is a current ability? Current ability does not mean as of today. The current ability means when the need would arise. And when you say when the need would arise, so we can say that you may have different kinds of rights. You may already be having a majority voting rights. I would say jiski lathi uski bhains. And I would say that unless there is anything to the contrary, if you've got majority voting rights, I would undoubtedly say that yes, you've got power. Now, if you're a party to a forward contract, it all depends upon whether the forward contract is going to settle before the meeting date or not. If you're party to an option contract, you just need to see whether you will exercise the option contract. Number one, it has to be deeply in money before you exercise that, and the settlement has to take place before the meeting date. If you can prove these parameters, then I think those rights will definitely give you a power as well. When we looked at the concept of an existing rights, we said basically two permutation combinations. One is you've got voting rights and or the right to appoint, remove KMP. Without any voting rights, simply having the right to appoint or remove KMP is challengeable. It will be difficult to prove the concept of power. But I think this is going to be more like an additional, a supplement right along with the voting rights, which can give you a power as well. So when we look at the voting rights, there are two combinations. One is that you've got majority voting shares. Other one is you've got less than majority voting shares. If you've got majority voting shares, unless mentioned otherwise, you'll get a power. But if it is subject to approval, you need to take a court approval. You need to take the approval of the regulatory authorities. You don't have a power. And the other combination is when you're looking at less than majority voting rights, any of these permutation combinations could result in a power. You enter into a contractual arrangement with another investor, you will get power. There is a potential voting rights, you may or may not get power. You also get the right to appoint a KMP, you may or may not get a power. It's all about assessment. You are not having anything else, but you are the single biggest shareholder of the company, below majority, relatively much bigger in size, you may get a power. Or there could be a blend of any other permutation combinations which could give you power. So this was on step one, power, the three elements of power, that is ER, CA, as well as RA. Now let's go to the step number two, but I think in terms of step two, we don't need to explain much. So I'm just going to give you two combinations in order to understand the spirit of the step number two. So let me see in the meantime, any questions coming in? No, I think all good to go. Now, when I come to the aspect of step number two, that is exposure to variable returns. That is the concept of exposure to variable returns. I think let's have a look at some permutation combinations on the basis of which I will decide is the exposure to variable returns there or not. And I think we'll simultaneously take the discussion on step three as well. So let's give you two permutation combinations. We'll make a small little chart in terms of the combination. We'll look at the step number one, the step number two, and the step number three. And we'll also make an assessment in terms of whether control is present or not. So let's take two combinations to illustrate the concept of step two as well as the concept of step three. So let's take this as particulars. And let's take this as step number one, that is power. Then this is step two, which is exposure to variable return. Then this is linkage, step number three, and we'll give the remarks whether control is present or not. So we're looking at whether the control is going to be present based on the assessments or not. So let's make a walkthrough on two combinations. One is on majority voting rights, and maybe the other one is which is on less than majority voting rights. So let's look at only two combinations. Well, let's say that as an investor, you've got majority voting rights. You've got majority ordinary shares in a company, more than 50% ordinary share, not subject to any kind of approval or court of law. You don't need any permissions, no ifs and buts. Now, I would say if you've got majority voting rights, is that an existing right? I would say yes. And will it give you a current ability when the need arises? I would say if there is nothing to the contrary, yes. And is it going to be useful in taking decisions on relevant activity? I would say yes. So majority voting rights are definitely existing rights, and they would definitely give you the power when the need arises, unless mentioned otherwise, to take decisions on relevant activity. Now, when you say you've got majority voting rights, that means you basically got ordinary shares. And if you've got ordinary shares, are you exposed to variable returns? I think everybody would undoubtedly say, yes, you're exposed to variable return. Because ordinary shares will not entitle you to any kind of fixed dividends, but it'll always give you a variable return. So I would say, yes, you will be exposed to variable returns. And since both these steps are yes, the linkage is there. And I would say, yes, the control gets established in this case. And majority of the questions which you see, which are the practical questions on consolidations, you will see in all those questions, the percentage of the holding which the parent has got in subsidy is always more than 50. And I think unless anything to the contrary, we will definitely assume that if you've got more than majority, more than 50% shares, I think control is going to be something which is undoubtedly a yes. Now let's have a look at another situation in this particular case. Let's look at the second combination. Let's say you've got less than majority voting shares. So let's say as an investor, you've got less than majority voting shares. And along with this, you've got PVR, potential voting rights. So you've got less than majority voting shares and you've got, let's say, potential voting rights. And we say that my potential voting rights are something which I will exercise deeply in money. And I'm pretty sure, yes, I will exercise. So when you look at that, are these existing rights? Yes, they are existing rights. Will they give you a current ability to exercise at the right time? Yes. And to take decisions on the relevant activities? Yes. Now comes the step number 2. And here sometimes we do make a little, a wrong assessment of things. Now you need to be very careful on one important thing. If you look at the ordinary shares, they will be giving you a fluctuating dividend. They will give you a fluctuating return. But if you look at the potential voting rights, for example, they are convertible debentures, they will give you a fixed return. So ordinary shares will give you a fluctuating returns, but as far as the potential voting rights, for example, convertible debentures are concerned, they're going to give you, you can say, a fixed return in this case. So am I exposed to variable returns? The answer is yes, I am exposed to variable return. So what are you saying? Well, there are two things, what you need to appreciate. I think let me just give you the larger picture. What you need to appreciate is, one is we use the word that you are entitled. The word is that you're entitled, and the word is that you're exposed. Look at the two words carefully. As an ordinary shareholder of the company, am I entitled to a variable return? Yes. Am I also exposed to a variable return? Yes. As an investor, if I've got, let's say, debentures in a company, am I entitled to a fixed return? Yes. But am I exposed to a variable return? Yes. So am I entitled to fixed return? Yes. My entitlement is to a fixed return, but am I exposed to a variable return? Yes. Now you would say, what is the difference between entitlement and the concept of exposure? Let's say, for example, I am getting a fixed salary from an employer. I am entitled to fixed return, but am I exposed to variable return? Tomorrow, let's say the employer is unable to pay the money. Then I'm definitely exposed to variable return. I am at the mercy of the credit risk of the employer. So let's say, for example, if you're investing in debentures, you are getting entitled to a fixed return in the form of fixed interest. But am I exposed to variable return? Yes, I am, because I am at the mercy of the other party, because if there is a credit risk, they may not be able to pay me the fixed return. So the standard does not use the word entitled, the standard uses the word exposure. So when you look at entitlement, this answer that you're getting a fixed return is from the entitlement point of view. You are entitled to a fixed return, but you're exposed to a variable return. So the standard is very clearly given the example that for the purposes of this standard, if you're getting a fixed interest, it is considered to be an exposure to variable return for the purposes of this standard. That you are entitled to a fixed interest payment, but due to credit risk, you're exposed to a variable return as well. And if step 1 and 2 is yes, this is automatically a yes, and a control will get established as well. So I think that was one good example to give you the inputs in terms of what is exposure to variable returns in this case. So this is as far as our control assessment is concerned. So I think, let me now tell you one thing. What you need to do in terms of this entire standard from an examination point of view, I would say there are basically a total of 4 inputs which you need to be clear. So I would say, let me just give you the chain of thought. So let me just give you a chain of thought that when you're looking at this particular standard from the examination point of view, what is the thought process? What is the chain of thought which you need to keep in mind what you're going to study in this particular standard? Something I give you similar in terms of financial instrument standard as well. Well, I would say if you're looking in terms of the standard, there are a few aspects of discussion one. The first one is to understand that what are the exemptions, what are the exemptions, and what are the exceptions. So we need to understand what are the exemptions and exceptions where the consolidated financial statements will not be prepared. I've already given you the insight in terms of the cases where the parent gets a choice, the chain holding situation, and where the parent is mandated not to prepare a the investment entity case. So this is situations where we have discussed the concept of para number 4, which is based on the 4 conditions what we have discussed. And I've also given you the concept of para number 4A, which is on the investment entity concept, where I give you a 3-step model in terms of things. So this is one area of discussion which you need to be careful on. So this is one area of discussion which you need to be careful. Exemptions and exceptions, get that clarity of thought that these are the cases where consolidation is not to be done. These are the cases where I tell the company you get a choice to consolidate or not. That discussion done. The second phase of discussion comes on the control assessment. The second phase of discussion in the standard comes on the control assessment. And in terms of control assessment, again, I have already made a discussion of the 3-step model with you, the power, the exposure to variable returns, and the linkage. But let me also tell you that if you look at the study material in terms of the control assessment, what they've done, they've also given a little discussion in terms of fund manager as well, which I have done, in the detailed lectures. I've already covered this aspect as well, where you look at the concept of a fund manager. How does a fund manager who may not be having a substantial investment in the funds, how would he get a control over the fund? So there are 2 kinds of questions on control assessment. One is based on a voting rights and one is based on a decision-making right. So this 3-step model which I've given you is based on the voting rights. The study material is also given, which we have done a detailed discussion in the detailed lectures, where we are looking at DMR, what I call decision-making rights. That as a fund manager, how do you get a control if you are in control of decision-making rights of the investee? The third area of discussion. The third area of discussion which is there is how to consolidate. How to prepare the consolidated financials, which is going to be my third focus of area for discussion today. So the third focus is how to prepare a consolidated financial statements in terms of consolidated balance sheet and also in terms of consolidated income statement as well. So we will focus on the balance sheet, income statement. You can refer the detailed lectures as well. So I'll give you the detailed steps and make a walkthrough in terms of what minute things you need to keep in mind when you're preparing a consolidated balance sheet as well. So that is one focus point. Invariably, you get questions in the exam on this area, a practical illustration. Either it goes on 103 or it goes purely on Ind AS 110. But generally, you get invariably a good question in the exams, how to make consolidated financials. Then there is another area of discussion which is there in the standard, and that is on the concept of the control. The control continues or the control is lost. The control continues or the control is lost. So these are certain permutation combinations given. We call it as a case. We call it as a case of step acquisitions, or we call it as a case of disposal of shares. This is another area of discussion which is given in the study material as well. So I'll be also making a walkthrough on this area as well. So I am now going to focus on this area. Then we come to the situation of step acquisitions and the case of disposal. When you acquire more share, the control continues, or even if you dispose shares, the control still continues. Or you look at a situation where the stake is sold and you convert into a significant influence, or you convert into a passive investor. So what happens when the control continues and what happens when the control is lost? There is a changes in the percentage of ownership resulting in a loss of control, or the control continues. This is the basic 4 inputs which I think you need to be clear in terms of the standard. This is more on the theoretical case study front. This is more on the practical front, which is there. So I think let's now go to the third area of discussion. How do you prepare a consolidated balance sheet in this case? So let me see any questions so far in between. All good to go. Okay. So let's, I think, focus on the next step, consolidated balance sheet. Now here I would insist, I would advise that when you are looking in terms of making a consolidated balance sheet, I would insist that please follow a step-by-step procedure. In the detailed lectures, I've done practical illustrations on various permutation combinations, including the concept of chain holding, where we have covered the aspect of consolidation on a step-by-step approach. So I'm going to give you a 7-step model, which you need to religiously follow when you're going to make a consolidated balance sheet. And trust me, if you apply this 7-step model, it's going to be very easy to construct a balance sheet in this case. So let's do one thing. Let's go to the 7-step model. Let's go to the 7-step model in terms of making a consolidated balance sheet. So we'll make a walkthrough on each step one by one. And of course, I hope you've already watched those lectures. And if not, please have a look at the detailed inputs with which we have applied this 7-step model. Because once you go to do practical illustration, you're going to get more hold in terms of things. Making a walkthrough in terms of 7-step model is not going to be enough. You need to see the questions, how they need to be solved at each stage. Now, I would say when you go to the step number 1, the focus is very clear. You need to identify 2 things. The moment you are in step number 1, I would say there are 2 things which needs an identification. The first thing is you need to watch out the date of acquisition. And the second is you need to get the percentage of holding. And I don't think so this is going to be a big concern in terms of the question, because the date of acquisition and the percentage of holding is something which you will get invariably, very clearly given in the question. So that's not going to be a challenge. Then you go on to the step number 2. And when you go to the step number 2, my advice is that you first look at the category of the question. Now, when I say category of the question, I divide all the questions of consolidations in terms of 2 categories. You're required to make a consolidation on acquisition date itself, which generally doesn't come in the exam because that question does not involve any kind of complications. And the second category is that you're required to make a consolidation which is at a later date, 1 year, 2 years, 3 years, whatever, but at a later date. So I would say at this stage, you should first look at the type of question. Carefully read the question, look at the category, the type of the question before you take a call. So there will be 2 types of questions broadly. One is that you're required to make a consolidated balance sheet on date of acquisition. It could be without NCI, that's not a problem. Because in this particular case, when you're looking at making a CBS on the acquisition date, whether it is with NCI or without NCI, that doesn't make a difference. Or it is a consolidated balance sheet at a later date. It is a consolidated balance sheet at a later date. Now we need to appreciate one particular inputs very clear at this particular stage. If you're looking at a consolidated balance sheet on the date of acquisition, I don't need any analysis of equity. I know the status of assets and liability on the date of acquisition itself. So in step number 2, you just need to do one sub-step. But if you're required to do a consolidation at a later date, you need an analysis of other equity and then get the status of the net assets on the date of acquisition. So I would say if you're required to make a consolidated balance sheet on date of acquisition, you can directly get the list of net assets on date of acquisition at a fair value. So what do you need to do? Just look at the question directly and you will be able to prepare a list of all the net assets on the date of acquisition at a fair value. Let me also tell you that when you're getting this list of net assets on the date of acquisition, trust me, your insights in terms of Ind AS 103 would also be helpful. Because when you go to consider the list of net assets, there could be a deferred tax as well. Because quite recently, you see questions on consolidation where the examiner is giving you a tax rate as well. So there could be a possibility of a deferred tax. And trust me, this list of net assets is 100% what you've done in 103. Those exceptions in terms of contingent liability, indemnification assets, deferred taxation, etc., equally applicable here as well. So when you're making this list of net assets, I would pinpoint that in this list of net assets, you need to apply all the considerations what you've studied in Ind AS 103 when you get the list of net assets on the date of acquisition out there. In the Ind AS 103 lecture, I have very clearly given you the inputs that what appears in the balance sheet of the acquiree goes in the acquisition entry at a fair value. What does not appear in the balance sheet of the acquiree may also enter the acquisition entries at fair value or maybe other than fair values. So you need to be careful on the major exceptions like contingent liabilities, indemnification assets, or maybe your deferred tax positions or any kind of intangible assets, etc. So be careful. So when you're making this list, look into the considerations done in Ind AS 103. Next. If you say the category of question is where you are required to make a consolidated balance sheet at a later date, I would say you need to go through two steps in this case. If you are given in the question to make a consolidated balance sheet at a later date, I would say step number 2A and then step number 2B. Go stage by stage. In terms of step number 2A, what do you need to do? You need to do the analysis of other equity. You need to do the analysis of other equity, where you need to split the equity in terms of pre and post acquisition earnings. I think we'll perhaps take a small little practical illustration with you after these steps to give you a little more better picture. But in terms of the analysis of equity, the larger picture, what you need to do, you need to basically split this profit in terms of pre and post. So you need to do the analysis, split this other equity in terms of pre-acquisition and in terms of post-acquisition. And if you've already seen those lectures as well, you would have seen that when you do the analysis of other equity, I would say there are a total of 3 focus points which you need to remember when you're doing this analysis of equity. So I'll tell you the 3 focus points which you need to take care. So I would say there are going to be a total of 3 focus points when you're looking at this analysis of equity. So when you look at the analysis of other equity, your focus point number 1 is you look at the balance sheet of the subsidiary company and do the analysis of other equity in the balance sheet. Look at each and every component of other equity, whether it is retained earnings, whether it is other components of equity. Make an analysis of each and every component of other equity, split it in pre and post. The second focus point is you look at the additional information and you need to incorporate the fair value adjustments in this case. So when you're doing the analysis, we need to go to the additional information, look at any fair value adjustments, all the fair value changes, a gain or loss is going to be pre, and then you also need to take care of any additional depreciations, etc. So you need to be careful that this is going to be inputs available in the additional information. Look at the additional info and see the fair value gains, fair value loss. All the fair value gain loss is pre, but remember to take care of the additional depreciation or reversal of the excess depreciations as the case might be. The third focus point is you need to take care of the stock reserve, but this stock reserve is something which is upstream transaction in nature. So when you're looking at the analysis of other equity, I'm not concerned with the downstream one. This is the analysis of other equity of the subsidiary company. And when you do the analysis of the subsidiary company, you need to consider that if the subsidiary company made a sale to the parent company, which is upstream in nature, the unrealized profit, which is stock reserve, needs to be eliminated from the post-acquisition column. Because unless mentioned otherwise, we're going to assume that the sale took place in a post-acquisition period itself. So minimum of 3 focus points which you need to take care when you do the analysis of other equity. Then you go on to the step number 2B. Then you go to the step number 2B. This is step number 2A, analysis. Then you go to the step number 2B. In terms of step 2B, now you're going to get the net assets at a fair value on the date of acquisition. And for this purpose, we will take the sum total of the equity share capital and the pre-acquisition profits, which you've already computed in terms of step number 2A. So we're not going to consider assets minus liability, but in this particular case, you're going to consider the sum total of equity. Equity is nothing but net assets. So when you're going to consider the calculations in this particular case, you need to add up the equity share capital and add up the pre-acquisition profits, which is available in terms of the analysis step number 2A. How we're going to exactly do that, we'll see in a practical illustration, but this is what you need to do. So the main crucial point is the step number 2. Very careful, watch the question carefully, read it carefully, get the inputs. Is it asking you to make a consolidation on acquisition date? I think that's a not very tough question. Doesn't really come in the exams as well, because you can directly get the list of the net assets. The crucial point comes only when the consolidation is done at a later date, in which case you need to organize your step number 2 in 2 parts. Get the analysis of equity, split pre and post with the 3 focus points, and then get the sum total of the share capital and the pre-acquisition profits and get the net assets. That is the step number 2. Then comes the input in terms of the step number 3. Then comes the input in terms of the step number 3. Now, I would say when you're looking in terms of the step number 3, many a times what happens, though you may not see that, in many of the questions in the exam, though of late, if you see, new additional points are being added in terms of the question. And I'll tell you something what you're going to do in terms of step 3. You need to focus on the purchase consideration. The purchase consideration in simple word means investment in subsidiary company. The parent company is made investments in the subsidiary. Now, anybody would say what's a big deal in that? As far as the investments are concerned, this will be available in the parent company's financial. So what's the big deal in that? Now, the big deal in this is that sometimes the examiner may give you certain forms of consideration which have not yet been accounted by the parent. Like, for example, he may tell you that there was a deferred consideration, or let's say there was a contingent consideration, and that part is not yet incorporated in the parent company's balance sheet. My advice is that if you see that there is any omission, if you see in the question that there is any omission in terms of the purchase consideration, I would say even before the step number 1, you make an extract balance sheet. I would say don't wait for things. When you read the question and the question tells you that a parent company gave shares to the subsidiary and there is a DC, he says the shares given has been incorporated in the balance sheet, but DC is not. So my advice is that if the investment in the parent company is leaving the deferred consideration, why don't you first make an extract balance sheet, look at the journal entries which were required to be done for the DC, and then if there is any unwinding of discount to be done, do those entries, make an extract balance sheet before step 1. Make this before step 1 itself. So this step, when you go to calculate the PC, will give you a track in terms of things, that you don't forget to consider the incorporation of those aspects. Because of late, if you see questions, there has been, like, I think one of the questions which gave you the concept of a DC. And what happened, that in terms of a DC, what they gave you was that there was a deferred consideration which was never incorporated in the balance sheet of the parent. And we were standing 1 year later. So you need to record the entry for the DC. You also need to go record the entry for the unwinding of discount of the DC. So the considerations which you've learned in terms of Ind AS 103 will come to your rescue, where I give you very comparative position in terms of, entries in step 7. So my good advice would be that if you see that there is any omission, by the parent company, if you see any omission by the parent company, please make an extract balance sheet. Indicate that if this entry would have been done, what would have been the changes in terms of balance sheet before the step number 1 itself, and then proceed with these steps. So that once you stand in terms of the purchase consideration, you've got a clear-cut picture in terms of that, yes, this is the figure of investment, this is the figure of PC. Then let's go to the step number 4. And in terms of step number 4, we're going to calculate the NCI. Now remember, when you're looking at the NCI, in terms of the NCI, you need to consider that there are two options allowed under 103. But there is another focus point also which you need to consider, that we need this NCI now on consolidated balance sheet date. So we need this NCI on the consolidated balance sheet date. So there are a few considerations which are quite a focus to be kept in mind. So when you calculate the NCI on the consolidated balance sheet, you are going to first take the NCI on the date of acquisition, which is as per Ind AS 103. So you're going to consider the NCI on the date of acquisition, which is based on Ind AS 103. And you already know that as per Ind AS 103, your NCI on the acquisition date can be taken at a fair value or at a PASNA. So this NCI based on 103 is either taken at a fair value or it is taken at proportionate share in the net assets. And to this, what we will do, we will add the share in post-acquisition profits. We will add the share in post-acquisition profits, which is going to be available from the analysis in step number 2A, which you've done analysis of other equity. So when you're calculating the NCI on the balance sheet date, there is going to be two steps, two stages in which you will do the calculation. Get the NCI on acquisition date 1 and then add the post-acquisition earnings. So whatever is the post-acquisition share, you just need to add the NCI share in that post-acquisition in step 2A. Now, there is one more very crucial point which you need to remember out here. And this is with regard to impairment of goodwill. Because this is one thing which we tend to get confused and forget. So there is one very important aspect what you need to keep in mind is impairment of goodwill. Now, we've already seen in terms of 103, and I made a mention that if NCI is at a fair value, goodwill is full. And if the NCI is at PASNA, the goodwill is supposed to be partial. And in consolidation questions, they definitely give you the impairment of goodwill as well. So here you need to remember that when you're looking in terms of impairment of goodwill, you need to see if the NCI is at a fair value, it is called a full goodwill. And if the NCI is taken at PASNA, proportionate share in the net asset, it is supposed to be a partial goodwill. Now, why is it important to remember this particular part is, if you say that the NCI is at a fair value and it is a full goodwill, then we will reduce the impairment loss from NCI as well. Whatever is the share of the NCI in the impairment of goodwill, he is going to bear that. So you will take the NCI on acquisition date, add the post-acquisition and reduce the impairment share of the NCI. But if the NCI is at PASNA and there is a partial goodwill, then no reduction from the NCI will take place, because NCI will not bear the amount of goodwill impairment in this case. So when you're looking at the NCI calculations, get your focus points clear that you got three inputs in the NCI. You consider the NCI on the acquisition date based on 103. You add number 2, the post-acquisition share available in step number 2A. And number 3, you need to reduce the impairment of goodwill depending it's a full or partial goodwill. If the goodwill is supposed to be full, you will reduce the impairment loss of the NCI. And if the goodwill is partial, then no impairment loss is to be deducted in this case. So get the focus points clear. It is very important to look at every focus point as you proceed on a step-by-step basis. That is step number 4. Let's go on to the next step, and that is step number 5. Now, in terms of the step number 5, you're going to calculate the goodwill, which is going to be a simple mathematical exercise indeed. So once you're calculating the goodwill, of course, this is going to be a simple little format. So what I'm going to do, I am going to consider number 1, PC. which you've already organized in terms of step number 3. And to this, you're going to add the NCI, which you've already organized in terms of step number 4. So you're going to consider your purchase consideration, which is already available in step 3, the NCI, which you've already organized in 4. But remember, this is the NCI on the date of acquisition. Remember, you are going to take this information from the step number 4, but not the total NCI on the balance sheet date. Goodwill is being calculated on acquisition date. You're calculating the goodwill on the date of acquisition. And since you're calculating on the date of acquisition, you need the NCI also on the date of acquisition. So not the complete figure in step 4, but only the figure which is on acquisition date. That's important. And then moving forward, once you add this, then we are going to compare this with the net assets at fair value, which is again on the date of acquisition. And this is available in terms of step number 2B. You have already organized this in terms of step number 2B, where you get the net assets at a fair value on the date of acquisition. And then you are going to get a goodwill or a bargain purchase gain, that is a capital reserve. And another focus point which you need to keep in mind, in this particular case is less the reduction in terms of goodwill impairment. So when you consider this, you need to reduce the impairment of goodwill also. And this impairment of goodwill is to be subtracted entirely. You don't need to watch out that this is based on a full or a partial goodwill. This is goodwill figure. So whatever is the impairment loss of goodwill, whatever is the figure, just reduce that figure. Don't consider a holding share in that. You need to consider the full impairment of goodwill at this particular stage. So this is the key points in terms of step number 5. And then we come on to the step number 6, which is again a very crucial step indeed. And that is calculating for the consolidated balance sheet the status of other equity. This is one inputs, we generally, think that let's calculate this directly, but I would say that please make a step carefully. Devote one particular step in calculating the other equity in the consolidated balance sheet. Get the status of what is the other equity in the balance sheet. So now there are few focus points as well. You got to consider the holding company's own other equity as a base. So we're going to consider the holding company's own other equity as a base. So I will take whatever is the parent company's other equity in his separate financials as a base. And I would say again, there are going to be 3 focus points. There are going to be 3 focus points which I need to consider in this case. Remember in the analysis, I gave you 3 focus points. Here again, I'm going to consider the 3 focus points again. Focus point number 1. You need to consider holding share in subsidiary post-acquisition profits. You need to consider the holding company share in the post-acquisition profits. And where you get that information, you're going to get this in step number 2A. The holding share in subsidiary post-acquisition profits is going to be available in terms of step number 2A. Second focus point, you need to consider the goodwill impairment, which is already there in the question. And when you consider the goodwill impairment, this is going to be a plus and this is going to be a minus. Now here you need to be careful that when you reduce the goodwill impairment, how much goodwill impairment is to be reduced? If it is a full goodwill, holding share. If it is a partial goodwill, whatever is the goodwill impairment. So you need to be careful that if it is a full goodwill, you will reduce the holding share. If it is a partial goodwill, you will reduce the 100% impairment figure. So remember that the amount of impairment loss to be reduced depends upon the goodwill is full or partial. If it is a full goodwill, you will reduce the holding share. If it is a partial goodwill, whatever is the impairment loss, the entire is going to be reduced. And another third focus point is you need to reduce the stock reserve as well, which is downstream in nature. You need to reduce the amount of stock reserve as well, which is downstream. Upstream was taken in analysis and downstream is taken at this particular stage. So when you're preparing the consolidated balance sheet of the parent company, this other equity is one of the very vital elements of the figure. So get a separate working note, take the parent company's other equity, get these three item plus minus, and you get the figure to be taken in the consolidation. And then finally comes my step number 7. Finally, we get the step number 7. And in terms of step number 7, you are required to make a consolidated balance sheet. And when I cover up the things in the detailed lectures, I had already given you the inputs in terms of what are the 5 basic rules which you need to remember in terms of making a consolidated balance sheet. So let's, I think, tell you those 5 basic rules, not the principle, but the 5 basic rules which you need to consider when you prepare a consolidated balance sheet. The 5 basic rules which you need to keep in mind is number 1, the share capital. The share capital of the subsidiary company is not taken in the consolidated balance sheet. We never land up taking the share capital of the company. The share capital of the company, subsidiary company, is never taken in the console. And I've given you all the logics in the detailed lectures. Only the parent company share capital enters. Then when it comes to the other equity, as far as subsidiary company pre-acquisition is concerned, it never appears in the balance sheet. But as far as the post-acquisition is concerned, it enters the balance sheet. The subsidiary company's pre-acquisition equity never appears in the console, but post-acquisition does appear. Then the investment, which the holding is got in the subsidiary, never appears in the console. The share capital never appears in the console. The investment never appears in the console. The pre-acquisition equity of the subsidiary never appears in the console. We aggregate the assets and liability. So we aggregate the assets and liability, and the assets and liabilities is aggregated always 100%. Irrespective of the percentage, we show the NCI. You got a 60% stake, you got a 100% stake, the aggregation is always done 100% in the books in the consolidation. And then what you need to do in this particular case, after aggregating the assets and liability, just remember goodwill and NCI are reflected as separate line items in the balance sheet. So when you make the consolidated balance sheet, the NCI and the goodwill are reflected as a separate line item in the balance sheet. The NCI appears as a part of the other equity in the last. So in the equity section, you present it after other equity. Goodwill, of course, appears as a separate line item in the balance sheet. These are the basic rules. Apart from this, you also need to remember that you need to consider the elimination of stock reserve. When you make the consolidated balance sheet, remember to eliminate stock reserve. The considerations of upstream, downstream transactions are going to apply in this particular case. And you also need to remember to eliminate the intercompany owings as well, because these things might be given in the additional information. So apart from the basic 5 rules, you also need to consider elimination of the stock reserve as well as the concept of elimination of intercompany owings. So this is the total 7-step model which you need to apply in order to make a consolidated balance sheet as well. I guess before we take the picture further, I think it's time to give you some break as well. I'm sure you need that. I have tried to condense the picture in terms of various components. So let's, I think, first give you a 10-12 minutes break. And then after that, I am first going to make a discussion on that loss of control and all. Then if the time permits, we can maybe do a consolidation question as well, because doing a consolidation question is going to take a huge number of time. I need to take up your doubts as well. So I think first we'll do the discussion of loss of control after the break. And then I think we'll pick up the questions and then see if the time permits, we'll see to take more inputs. But I think let's first give you a break at this stage. So 10 to 12 minutes. I see you friends after the break. Enjoy your break. Thank you. Welcome back, friends. I hope you had a relaxed mind. And you must be thinking that clothes changed. I think the shirt has changed. I think the weather was getting so humid indeed. The AC is also not working. So I thought, let me just quickly change the wardrobe as well. So anyway, so I think let's begin the journey back again. So I had given you the insights in terms of the various steps which are involved in terms of making the consolidated balance sheet, the 7 steps, the key focus points, what you need to keep in mind when you're doing the consolidation as well. I think let's now first go to the next phase of discussion before we'll take your problems. So I think I'm going to go to the next area, that is the percentage change in ownership interest, in which case it could lead to either a loss of control or it could lead to a situation where the control still continues. So I'm going to make your life very simple on that particular area, because this is one area where you could quickly, put down things in a journal entry format and you can work out any permutation combination. So first, let's give you a chain of thought, and then based on that, I'm going to give you some very simple inputs with which you can handle any permutation combination. So my discussion area is the percentage change in ownership. My discussion area is the percentage change in the ownership interest. So if there is any change in the percentage of ownership interest, how we are going to tackle the same. So I would say there are two permutation combinations which could arise broadly. I would divide the entire set of discussions into two broad categories. Number one, I would say a case where the control is not lost, but it continues. So we can say one situation is that the control continues. And the other situation is where the control is lost. Where the control is lost. So when you look at a question in this particular case, you need to first of all broadly divide this in two parts. You need to see that the question is going to result in a loss of control or the control continues. For the permutation combinations, if you look at the fact that the control continues, I would say there are going to be two situations. Either it is a case of further acquisition, or it is a case of disposal, but still the control continues. So just to give you a very basic example to make it clear, a further acquisition B could be, for example, you had a 60% stake and it became 70. A disposal could be, let's say you had an 80% stake, you disposed and you're still on 70, but the control still continues. So it could be either a case of further acquisition or it could be a case in terms of a disposal. But in both the cases, the percentage changes, but the status of control remains the same. That means you are still within Ind AS 110. That's the main focus point. That when you say the control continues, I would say the typical input is that in this case, Ind AS 110 continues. Ind AS 110 continues to apply in this particular case. So the control continues. Similarly, we can have a look at the control is lost. Now, if the control is lost, there can be two broader permutation combination. One is it is a case of 100% disposal, a full disposal, where the relationship itself comes to an end. Or the second case is that it could be a case of a partial disposal and the relationship undergoes a change. So when you say it's a full disposal, that means everything is sold, the end of the story. But if you say if it is a case of partial disposal, there could be more permutation combinations coming in. So there could be more permutation combinations coming in. And I would say there could be a total of two combinations which could arise. Number one, you shift over from a control to a significant influence. That means you're going to switch over to Ind AS 28 because now it becomes a case of an associate, a significant influence. Or it could be a case where you sell shares and from a control, you become a passive investor. And when you become a passive investor, you're basically going to switch over to Ind AS 109, where there is no relationship left over. Trust me, these are all the permutation combinations which could arise. And if you see, one unit is completely devoted to this particular chapter. There is a percentage change in ownership interest, and all these permutation combinations are given. Now, what I'm going to do, I'm going to make your life absolutely simple because I'm going to broadly consider the case when the control continues and when the control is lost, irrespective of any permutation combination for that matter. So let's, I think, first consider the case where the control is lost, whether it is a case of full disposal, whether it is a case of partial disposal converting to associate, or it is a case of partial disposal where you get converted to a passive investor. Let's take that as block one. So I am considering the accounting, the calculation when the control is lost. Now, I would say you need to be careful in terms of the requirement of the question, and you need to see what is the question asking you. Is he asking you to calculate the profit or loss from the separate financial statements point of view? Is he asking you to calculate a profit or loss from the consolidated financial statements point of view? Because the calculation of the profit or loss on sale in terms of separate and consolidated financials is going to be different. So you need to see that, are you working out the profit or loss from the separate financials perspective, or are you calculating the profit or loss from the consolidation financial statements perspective? Now, as far as the calculation of the profit or loss from a separate financials is concerned, it is simple. Because you just need to compare the sale proceed versus the book value of the investment, the book value of the portion which is sold, and you get the profit or loss. So separate financials is going to be simple and straight indeed, where I am going to consider the sale proceeds of the portion sold, and I'm going to compare this with the book value of the portion sold. I will not consider the entire book value, but we're just going to consider the book value of the portion sold. So if it is a partial disposal, or let's say if it is a full disposal, whatever the case might be, but if it is a partial disposal, you'll take a pro rata carrying amount or the pro rata book value for the purpose of calculating the profit loss on sale. Compare the two values and you get the profit or loss on sale. Simple. This is quite similar to what you do in terms of ICAI accounting as well. You compare the sale proceeds versus the proportionate book value of the investment sold and you get the profit or loss. Simple and straight. Now, when it comes to consolidated financial statements, I would now advise a shortcut technique, whether it is a case of full or a partial disposal. I would think like this, that when you acquire a control, you put the acquisition entry under 103. And if the control is gone, why don't you put a reverse entry of 103? Makes complete logical sense. It's something, a reverse treatment. When you acquired a control, you did 103 entry of acquisition. Now, if the control is gone, just reverse that entry. So trust me, in this case, any permutation combination, I will basically do a reversal of Ind AS 103 journal entry. I will basically pass a reversal entry of Ind AS 103. Now, let me show you how this entry will be done and how you're going to calculate the minute components of that entry. So let's have a look at the entry. Since you made a sale, there will be a bank account debit, which is going to be equal to the sale proceeds. And that would be very clearly given in the question. I don't see any challenge in terms of getting the figure. What is the sale proceeds on sale of the investment? Number two, there is a possibility that there is some investment which is retained when it is a partial disposal, and we will take the fair value of the portion which is retained. So when you're going to consider this entry, the investment will be debited if there is any investment retained, if any. If it is a full disposal, of course, there will be no investment debit. But if it is a partial disposal, you will debit the investment which is retained with the fair value of the portion retained. Now, what do you need to do further? When you did the acquisition entry, you recognize the net assets, now de-recognize it. You recognize the NCI, now de-recognize it. You recognize the goodwill, now de-recognize it. So three things were the focus point in the acquisition entry. Net assets recognized, NCA recognized, and goodwill recognized. Now it's time to de-recognize because consolidation cannot continue because the control is lost. So what I need to do, the NCI will be given a debit to de-recognize it. The goodwill and the net assets will be given a credit to de-recognize it. And this will be based on the values on date of disposal. We will consider the values on the date of disposal in this particular case. So trust me, this is the comprehensive entry for any permutation combination, whether it is a case where there is a full disposal or there is a switch over control to significant influence or a control to a passive investor. The bank is with the sale proceeds clearly given. Investment is with the fair value of the retained portion clearly given. NCI goodwill net assets to be taken at the values on the date of disposal. And then once you do this entry, there will be some balancing figure in this entry as well. And any balancing figure in this entry is going to be taken in the profit and loss account. That represents the gain or loss on disposal, and that would be taken in the P&L. Trust me, try any permutation combinations which are given in the study material. This entry rocks. So you can simply put this entry. So look at the focus of the question. Are you required to calculate a profit and loss from the standalone point of view? Then simply compare the sale and the book value. If you're required to compare the profit loss from the consolidation point of view, just put the Ind AS 103 reversal entry, which I've given you, and you get a profit or loss on sale as a balancing figure in this entry. Simple. That was the case number 2, which I did, where the control is lost. Now let's have a look at another case where we're looking at the control continues. So we're looking at the case when the control continues. That means Ind AS 110 continues to apply in this particular case. So which means I am on this case, where the control continues further acquisition or a case of disposal. So let's see how would a further acquisition and a case of disposal apply. So let's have a look. So I would say, yes, the entries are quite common, but I think still let's segregate this in two parts, where it is a case of further acquisition, or it is a case of disposal of shares. Now here again, my focus point would be in terms of, are you looking at the separate financials or are you looking at the consolidated financials? I think if you're looking in separate financials, it's not a big deal because a normal IGAAP accounting entries will be done. But let's still have a look at that. If you're looking at from the point of view of separate financials, what is done, consolidated financials, what is done. So let's broadly divide this into two sections, and this one also in terms of two sections. If you're looking at the case of separate financials, or you're looking at the status of consolidated financials, let's see how the permutation combinations is going to work. Now, if you say that it is a case of further acquisition and separate financials, you are just going to put an entry, investment debit, and the bank gets a credit. This is with the cost of the new investments purchased. A normal entry will be done. In this particular case, you're requiring more investments. And if you're requiring more investments in this particular case, you just need to consider investment gets a debit and the bank gets a credit in this particular case, which is equal to the cost of the investment. Similarly, if it is a case of disposal, you'll put the entry bank debit. This is with the sale proceeds and the investment gets a credit. This is with the book value of the investment sold, and any balancing figure in this is the gain or loss. And the balancing figure in this case, the gain or loss, is going to be taken in the profit and loss account. Simple and straight. So in this particular case, it's a further acquisition, normal case. It's a disposal, a normal case. Just the normal IGAAP entries will be done in this case. Now comes the consolidated financials. Have a look carefully. If it is a case of further acquisition, well, remember first of all, goodwill will not undergo a change. If it is a disposal, goodwill will not undergo a change. We are not going to change the goodwill, whether it's a further acquisition or whether it's a case of disposal. Because in this particular case, the standard says that when the control continues, the two shareholders are dealing with each other. The majority, that is the controlling interest, and the minority, that is a non-controlling interest. It is a transaction between the equity shareholders and the percentage is changing. So the only thing which will change is the NCI. From a consolidation point of view, remember one thing very clear in this case as well as in this case. In both the cases, the goodwill remains the same. The goodwill remains the same. There is no change in terms of goodwill. So whatever goodwill was identified at the initial stage, the goodwill continues. The only thing which changes in this particular case is NCI changes. NCI changes in this particular case. It's a transaction where the NCI percentage will change. If it is a further acquisition, NCI goes down. And if it is a disposal, the NCI goes up. So the entry, if it is a further acquisition, we need to debit the NCI, reducing the NCI, because the NCI will decrease at the end. Whatever money is paid in terms of the cost of acquisition would appear here. So the journal entry which you're going to pass is NCI gets a debit to the extent of proportionate reduction. So you will be given an NCI in the question, and that NCI is based on an old percentage. And now you need to get the reduction in the figure of NCI pro rata. So take the debit to the NCI and the credit to the cost, credit to the bank. Any balancing figure in this entry is going to be taken directly to SOKI, that is equity. This is not going to be taken in the profit and loss, because in this particular case, it's a transaction between the shareholders of the company. And the standard says that if it is a transaction between the shareholders, then any gain or loss is going to be directly taken in retained earnings, that is other equity. Nothing hits the P&L. Similarly, if you look at the consolidated financials, in case of a disposal, what do you need to do? The NCI needs to increase. So when you made a sale, the bank gets a debit to the extent of the sale proceeds received. And the NCI is to be increased in this case on a pro rata basis. Because on disposal, your stake dilutes, the NCI stake goes up. And any balancing figure again in this particular entry is going to be directly taken in SOKI, that is statement of changes in equity, retained earning. So you can see in separate financials, it is entering the P&L, profit or loss on sale. But in terms of consolidation, it is entering directly in equity. So moral of the story is that if there is no loss of control, the only thing changes is NCI. If there is a further acquisition, NCI goes down. If there is a disposal, NCI goes up. Any profit or loss is taken to equity. And if it is a case of a loss of control, just do the reversal entry in the Ind AS 103 and the balancing figure gain loss goes to the P&L. That's it. You look at any permutation combinations in this case, all is the same. Now, if you see what I have done when I give you the mind map in this particular case, I think let's just quickly conduct you in terms of the chain of thought. I have tried to cover, the maximum inputs in a shorter span of time. I gave you the exemptions and exceptions in terms of consolidation. I've given you the input of control assessment, the three-step model. I gave you how to make a consolidated balance sheet, not an income statement. We'll discuss that, but I think we'll first take your questions on that. And I've also given you that if the control continues or there is a loss of control, what kind of entries are done in the separate and in the consolidated financial statements. So that was a crux in terms of the 4 inputs which are given in Ind AS 110. So I'm left with this pending issue as far as income statement is concerned. But I think before we discuss that, let's see, I think some of you are connected out here. So let's, I think, first take your questions. And if then the time permits, I'd like to give you quick inputs on the income statement. But I think first, let's take your questions at this stage. So please go ahead. I think for any questions coming to your mind, I think Raj, Ashutosh, and I think GSK Verma. So I think you're connected. So maybe you can put across your questions. Please go ahead if you've got questions. You can please raise your hand if you've got questions. Then we'll just unmute you. I guess your voice is not coming, I think. Mr. Verma, I can't hear you. Okay, Ashutosh, Raj, you've got any questions to ask? Any questions? Raj, Ashutosh, you've got. Otherwise, I think I'm going to go to my discussions on the income statement. If there are no questions coming in. Okay, I think I am not getting any questions at your end, which means all good to go ahead. So I think we can take our discussions further. Let me just still ask one more time. Raj, Ashutosh, I think you're there. Any questions coming to your mind? Anything which you want to ask me? You're not muted. Okay, I'll unmute you. Sorry. Yes.
No, sir. Thank you, sir.
Yes, please go ahead.
Yeah, I have no any question. Please go further.
Okay, all good. Okay, wonderful then. Any questions, Raj, from your side?
Really, you have well study well.
Okay, thank you. Raj, you got any questions?
Yeah, sir, I got. uh, when there is a chain holding
Hmm.
and the parent company is having indirect control as well as an direct control as well.
Okay.
So the share we will take to calculate will be combined or a separate one.
Okay. Let me, I think, just show you in the form of a chart, I guess. So I think the question goes something like this, that there is a company A and it has got a control in B, B's got in C, and A is in C, right?
Yeah.
Okay. Now, I would say as far as A in C is concerned, it's direct plus indirect.
Yeah.
The questions which have come in the exams on chain holding is typically this chain. This part was missing in those cases. So let's take the case that let's say this is 30, let's say this is 80, and let's say this is 60.
Yeah.
So I would say A has got a 30% direct stake in C, and you can say that A is got in
80
terms of
into
C,
60.
80 into 60, 48.
48.
So that makes it 78% for the parent. So I would say 22% becomes NC.
So for NCI calculation, it will be 22%.
Correct.
But for reserve and surplus and other earnings.
Everything. You see, when you're going to consider the analysis of other equity, you don't split the analysis of equity at step number 2. But when you go to consider the NCI, you will take the post-acquisition share, which is 22%.
Okay,
Right?
post.
Yes, because all the NCI calculation will be based on 22. In fact, even if you look at the questions on chain holding,
I'm saying
which have
reserve
come in
and
the
surplus.
exam. Yeah.
I'm questioning that reserve and retain earning of the company will be taken over at
22.
22.
Because when you're going to take the NCI, it is 22. So when you do the NCI calculation, you'll take 22% of the post acquisition. And when you make the consolidated balance sheet, that's step number 6, other equity, you're going to take 78% of the parent share. So split of the entire reserve and surplus, or I would say other equity, is going to be 78 and 22% in that case.
So while in the question it's taken directly 80 or 60%.
Which
There's a
question are you talking of?
There's one question in study mat of chain
Actually,
holding.
there are two methods to do it. One is the direct and one is the indirect method. So I think if they've applied the other way around, there are two methods which are there. This one I feel is more, appropriate because considering the solutions, what they've given in the chain holding for the previous two questions in the exam. So they've always taken NCI on this basis. Like even if you forget this
No, the
30,
NCI is calculated on that basis, but while adding the reserve and surplus, they have taken the original shares.
no, you mean to say when they took the NCI, they've taken the NCI to be 10%. The
NCI,
NCI is taken at 10%.
no, NCI is taken at 22%. That's right.
Right. And in the NCI, when you take the post-acquisition share, again 22%.
In NCI, it has taken all the balancing figure.
It has to be 22. If you're taking a share capital, for NCI, you took the NCI on the date of acquisition, which is based, as you said, on a 22%. How would mathematically it'll agree if I take it at 10%?
So it might be, I have to see. Okay, they have taken 80%, 60 percentage. Okay, I will check it once. They might have taken 60 only.
Okay. Because in any case, even if you look at the chain holding questions, the very
Yeah.
first thing we always do, what I do is in a chain holding question, if you've seen the detailed lecture, I calculate the percentage of holding in step one. The moment I get the percentage of holding, it is always based on direct plus indirect. So then I calculate the NCI. Then in entire solution, my NCI will go at a 22% only.
And everything will be calculated on the basis of this ratio only, 28 and 22.
Correct, correct. Absolutely, absolutely. You see, the moment you do step number 2A, you do the analysis. At that stage, we don't split. Even in terms of 2B, you just get the net assets on acquisition date, which is a full 100% value. We don't apply any percentages in terms of step two. At least I don't apply anything on step number two. Now, when it comes to the NCI, then at that particular stage, we need the post-acquisition share. I'll pick up the figure of the post-acquisition from step number 2A and take 22% of that. Then when it comes to the step number 6, when I take the other equity in the consolidated balance sheet, I'll take 78%. Because in that case, I need the share of A in B and the share of A in C in the other equity consolidated balance sheet. So when I'll take A in B, I will take A in B 80%. And when I take A in C, I'll take 78% only. Because in effect, A has in C 78% direct indirect. So my calculations on step 6 will be 78%. And the NCI, which is step number 5, I guess, is going to be 22%.
Yes, I got. All the calculation will be done on this ratio only.
Absolutely, absolutely. Right. Does that answer your question? Any further questions? More questions to come?
So one more thing, it's not of this, but when we say goodwill can never be for goodwill, there will be never a DPL
Yes.
because of the cyclic thing.
Correct. Correct. Because as per industrial, the moment you recognize uh, detail for goodwill in a acquisition entry, it lead to a circular problem. It's more like an administrative issue due to which the standard prohibits you in recognizing a detail. But DTA, yes.
Okay. Can you just give me a bit of it? What exactly happens?
Okay. Okay. Not a problem. I'll tell you.
Exactly.
Let's take some figures and a journal entry to get a larger picture. So let's say this is the acquisition entry, which we are passing in 103. So let's take some arbitrary figures. Let's say I've taken the net assets and I've taken the purchase consideration and the NCI. So let's say the net assets is to the extent of, let's say 100 crores. And let's say the purchase consideration is 60 crores, or let's take it 80 crores. And let's say the NCI is 30 crores. So we can easily identify that there will be a balancing figure goodwill which is to the extent of 10 crores. So this is the status without taking a deferred tax. Now, for whatever reasons, let's assume for a moment, let's say the carrying amount of the goodwill is, let's say 10 crores only, what you've got in the entry. And let's say the tax base of this goodwill is, let's say, to the extent of 6 crores. So can I say 4 crores is a deductible taxable temporary difference? Am I right?
Yeah.
So let's consider a tax at the rate of 40%. Can I say I'm going to get a DTL to the extent of 1.6 crores? Now, let's assume for a moment that I say, no, I want to record this DTL in this entry. So let's still record it, irrespective of what the standard says. So I put this DTL on the credit side, that is 1.6 crores. Will this entry tally, or do you think it'll go for a toss?
So the calculation will change, and then goodwill will change to the same.
Yes, the balancing figure changes to 11.6 crores due to this DTL.
Okay.
Now what happens when you say that this has become 11.6? That means I need to add this incremental goodwill as a part of my taxable temporary difference, correct?
Okay.
So when you add this 1.6 crore, which means there is an incremental DTL of 40%, that is, I think, 0.64. 1.6 into 40%. So I need to add another 0.64 crores DTL, which means I need to change this figure because there is incremental DTL, which means this will again change.
But same will happen to DTA as well, na, sir?
I
will
like it.
reduce.
Yes, I knew that question coming in, but you got the circular effect, right?
Yeah.
Great. Now let's come to the DTA position. As you rightly said, if you look at a DTA position, so let's take the entry, you take the net assets and you take the PC, you take the NCI on the credit side, and you get the capital reserve, you get the goodwill as a balancing figure. And now it is resulting in a DTA. So let's say this is resulting in a DTA. Now, let me ask you, is this DTA going to increase the credit side or the debit side?
Debit side.
No, when you're going to put the DTA on the debit side, the debit will exceed the credit, correct?
Or it will reduce the goodwill.
No. I'll not put it like that. It'll increase the debit side. That means you're going to get capital reserve as a balancing figure in this entry, correct? Not goodwill. I'll not say that it decreases goodwill. I would say a DTA will create a capital reserve to be more correct. Agreed?
Okay, in that sense.
Yes. Now, capital reserve is not an item of asset and liability. Goodwill is an item of asset. When you apply Ind AS 12, you consider the deferred tax asset liability on assets and liability, not on equity. So capital reserve being an item of equity, this will not lead to any further deferred tax consequences. People would say that it is decreasing goodwill. I would say it is creating a capital reserve. Then you can set off the goodwill and capital reserve in the balance sheet for presentation point of view. But at the end of the day, by creating a DTA, you create a capital reserve. I would not say decrease the goodwill.
But if we have a goodwill, we want to create a capital reserve now.
But then you can net off the two and present the net figure in the balance sheet. So let me put it like this.
So the DTA will go directly to the capital reserve instead of reducing goodwill.
So let me put it like this. Vouch me for that. Can I say if you create a DTL, it creates a goodwill, right?
Okay.
No, you agree with that, right? I'm going to say two sentences, right? Second, if you create a DTA, it creates a capital reserve.
Okay.
And if it creates a capital reserve, it is an item of equity, not asset liability. So no further deferred tax consequences would arise. So I would be getting a goodwill in this entry. I would be getting a capital reserve. I will net of the two and present the net figure in the balance sheet. But then I would not say that I'm decreasing goodwill. I will say I'm creating capital reserve.
Okay, so the representation will be different. That's why it will not impact goodwill.
Yes. Because at the end of the day, the standard setters thought that when you create a DTL, it creates additional goodwill. When you create a DTA, it creates a capital reserve, and I would not say that it decreases goodwill. If I start looking at a creation of DTA decreases goodwill, I'll see the similar circular effect, what is there in terms of a DTL. But this similar circular effect will not be seen if you say that it creates a capital reserve rather than saying it decreases goodwill.
Whenever we will get a DTA, we will first record capital reserve, and then for representation purpose, we will.
Yes, exactly.
Thank you.
You're welcome. Go ahead for any further questions you've got.
Okay, so with respect to this chapter only, or
Oh, if you want something else, you're most welcome. That's not an issue.
probably. So with respect to that investment entity,
Mhm.
so the definition and condition to be eligible for an investment company, is it crucial to note that, because it might be probable that there may be question on it, whether a company is investment or not.
Okay. Well, if I look at the past examination trend, I might say, that it's never been touched in the exam. But that cannot be the base actually, because I consider that since, you're going to get MCQs in the exam now, since the last attempt, MCQs have been coming in. And my personal viewpoint is, it's a personal viewpoint. It's not what I'm, saying from the institute point of view. My personal viewpoint is that when it comes to MCQ, I think the kind of knowledge we require is more intricate in nature. So you may not sometimes get a larger question on investment entity, but say for example, I give you a small MCQ. I know that there are three parameters of the definition criteria. I give you four options out of which you have to select which three options are applicable. So they give you some combinations. Let's say they write a sentence, an investment entity is one which meets the following parameters A, B, C. Then they give you some correct parameters, some wrong parameters, and then they give you options which of the parameters are correct. All the three, A and B, A and C, B and C, something like that. So I would say that yes, some sort of a basic knowledge is required. Then, there have been certain case studies also where they've elaborated the characteristics as well. So I would say at least get some good hang on the investment entity concept. I know the course is quite vast, and many times students tend to think, let me filter out the ABC criteria of the paper. That's what we used to do as well as students. And we used to filter out that, this has not been very important in nature, let me skip it. But my thought process is, considering MCQs will be very scoring indeed, because you're going to get almost like 30 marks of MCQ. And if you're able to crack those 30 marks of MCQ, that's quite a bit in terms of, easily passing the paper. So I would say spend time, but you can draw, maybe your own inputs in terms of how much time you're spending on that, but at least get some good knowledge. Because when you're looking at investment entity, there are three definitions, four characteristics apart from that. And then there are small little illustrations in the study material pertaining to those areas as well. So I think some sort of a basic knowledge, if not a very advanced knowledge, would definitely be required.
Okay, so you can continue with the income statement.
Okay, great. Right. So I think let's go ahead. I think the question stands answered. Now we have good enough time, I think, to give you some inputs on how do we make a consolidated income statement. Now, there are two, three crucial points which I would like to draw upon when we look at the consolidated income statement. So let's have a look. So when I'm making the consolidated profit and loss statement, there are two, three things which I need to keep in mind. So I'll highlight them as a concept. You want to look at a larger question. I think we've done one questions in the detailed lectures as well. You can see that part as well. Now, when you consider, for example, the revenue, the focus point one is that you add holding and subsidiary. It's aggregation of incomes. It's aggregation of expense. Just like a consolidated balance sheet, you aggregate assets and liability, you aggregate as the incomes and expense as well. Now, what you need to take care is number one. I would say when you consider the aggregation of the subsidiary, you must look into one simple little input. Is the date of acquisition in current year or is the date of acquisition, you know, earlier in the past? It is earlier in past. So that's one crucial point you need to watch out, that when you are looking at aggregating the figures of the subsidiary, this is one focus point which you need to be clear. Look at the date of acquisition. Is the date of acquisition somewhere in between the current year, or is it prior to the current year? If it is in between the current year, you need to consider the figures on a pro rata basis. You need to consider the figures only for the post acquisition period. So let's say, for example, the date of acquisition is, let's say, after 4 months of the current year. So you need to consider only 8 months figure. So if the shares were acquired, let's say, after the 4 months of the current year started, so it's a middle acquisition, 4 months after the current year, you need to consider 8 months. Only the post acquisition period needs to be considered. That is one. But if it is supposed to be earlier in any prior years, then of course you can consolidate the entire 12 by 12. So this is one focus point, that when you consolidate the figures, you need to consider the subsidiary for the entire 12 months or pro rata. It all depends upon the status of the date of acquisition. Second, the second most important crucial point is you are going to reduce any intercompany sale purchase as well. You need to eliminate any intercompany sale purchase. So when you add the holding and subsidiary, it is possible that holding made a sale to subsidiary or vice versa, and this intercompany will be reduced irrespective it is downstream and irrespective it is upstream in nature. It doesn't make a difference in terms of revenue. So when it comes to the balance sheet, you are concerned it is upstream or downstream, but when it comes to the consolidated P&L, in this particular case, I'm not concerned upstream, downstream. The intercompany sale purchase is going to be eliminated irrespective up or down. That is one focus point. I would say this is one focus area, or let's put it as two. Then comes the second aspect of discussion, that from this revenue, when you reduce the cost of sale, now here we need to be a little more careful in terms of things. Same inputs will be taken, holding plus subsidiary. Subsidy, of course, will be based on this entire data itself. And you're going to reduce the intercompany as well. And you need to add the stock reserve. Now, this is the crucial point, that when you consider the cost of sale, here we eliminated the intercompany sale. Here also we eliminated the intercompany sale, but what you need to do further, you need to add the stock reserve. Now, one thing which people tend to get confused, when they're reducing the intercompany sale, they think, do we reduce that sale which is still unsold, or do you reduce the entire sale and purchase? You need to reduce the entire intercompany sale purchase. Whatever is the entire intercompany sale purchase, you're going to make a reduction of the entire intercompany sale and purchase. But stock reserve, of course, will be to the extent of the unsold goods. So when you're going to take the stock reserve, it is to the extent of unsold goods only. And remember, this stock reserve is going to be added irrespective it is downstream or upstream in nature. Here again, in the income statement, it does not make a difference. So stock reserve would remain the same, whether it is downstream or it is upstream transaction in nature. So I think this is the third focus point, what I need to take care. So let me just consolidate. There is one more inputs to be given. So I would say when you do a consolidated income statement, your focus points needs to be clear. That first thing you need to see is the acquisition date. If the acquisition date is in between the current year, you need to aggregate proportionate revenues and expense. But if the acquisition date is prior to the current year, you're going to aggregate 12 by 12. So the main focus is you need to consolidate only the post-acquisition period of the current year. So either the entire year is post-acquisition or it is proportionately post-acquisition, and you take care. Focus one. Second, the common sale purchase between the parent and subsidiary eliminated both from the sale and purchase. And trust me, when you eliminate the intercompany sale and purchase, it doesn't impact the profit. If you reduce 100 rupees from sale, 100 rupees from purchase, the impact is zero. So what you need to do is you need to add, remember, add the stock reserve. You're adding the figures of holding subsidiary minus intercompany owing, add the stock reserve. The stock reserve will be on the unsold goods, and it doesn't make a difference. It is upstream or downstream in nature. Now, one very crucial inputs in terms of the income statement. Now, you've got the profit for the year. You got the profit for the year. Now, this is something very crucial to watch. This is from the profit and loss section. Let's take this as A. And then you got the other comprehensive income. Let's call it as B. And you get the total comprehensive income. And let's call this as A plus B. So when you going to make a consolidated income statement, you're going to take the profit for the year, you're going to take the other comprehensive income, and you're going to get the total comprehensive income. Now you need to be careful that at the end, when you get the total comprehensive income, you need to make a split. You need to make a split. You need to split this. We need to consider what is the profits attributable. We need to segregate the profits attributable to the holding company and the NCI. So you need to consider the split of this figure A. Whatever figure is computed A, you need to split this between NCI and the holding company. We will compute this NCI figure and we will take this as a balancing figure. When I'm going to consider the figure of A, I'm going to calculate the NCI and I'm going to take the parent as a balancing figure. Now, when you compute this particular figure, let's see how are you going to compute this figure. This is the crucial point. When you calculate the NCI share in this profit, you don't need to take the reported profits into account. So what will I do? I will take the share of NCI. I will take the share of NCI in rectified profits. Remember, when you're calculating the share of the NCI, you need to consider the share of the NCI in the rectified profits of the subsidiary. So the reported profits given in the question are to be converted in terms of rectified profits for this calculation. And I'll give you the insight in terms of how this conversion is going to take place. So what will I do? I will take the reported profits of the subsidiary as a base. So we will take the reported profits of the subsidiary as a base, and there are 2-3 adjustments which you need to take care. Number one, if there is any stock reserve upstream in nature. Number two, you need to consider any goodwill impairment if the NCI is at a full value. And number three, if there is any assets taken at a fair value and there is any kind of additional depreciations required. So there will be again a total of 3 focus points. Everywhere you can notice, 3 focus points, 3 models and 3 focus points out here. So you're going to take the reported profits as a base, and to this, what you're going to do, you're going to consider the stock reserve, which is upstream in nature. This will be reduced. You will also reduce the goodwill impairment. The goodwill impairment will be reduced only if it is a full goodwill. So we will take care of the full goodwill because we need to reduce the NCI share in terms of goodwill. And we also need to consider another impact as well. The third adjustment is additional depreciation. If the assets have been taken at a fair value, we also need to consider any additional depreciations on them. So watch out in the additional information that there is stock reserve upstream. There is goodwill impairment if it is fair value portion of NCI full goodwill, and there is an additional depreciation. So this reported profit gets converted into what we call rectified profits. So once you get the rectified profits, you will calculate the share of NCI in that rectified profit. So once you don't need to take the share in A, mind you. You don't need to take this A as a base. You do the separate calculations from A. You say this computed figure, a rectified profit NCI is there, balancing figure belongs to the parent. And then further, what do you need to do? This total comprehensive income is also to be split in terms of things. You need to split A between parent NCI. You need to split A plus B. B is not to be shown separately. We need to show the segregation of A between parent NCI, A plus B between parent NCI, not B. So this will again be segregated, the profits attributable, the profits which is attributable to parent company and the NCI. So this is the sum total of A plus B, which you are segregating. And this again is to be segregated between the NCI as well as the parent company. Now, what are you going to do in this particular case? This computed figure, just add the OCI share. So as far as this figure is concerned, take this computed figure as a base and add the share in OCI. See if there is any share of the NCI in the OCI. So whatever is the OCI of the subsidiary company, see what is the NCI share in that. And again, you can take the holding as a balancing figure. So let me just quickly consolidate the inputs in terms of consolidation of income statement. I would say there are a total of 4 focus points which I need to consider. So just keep the 4 focus points very clear when you're doing a consolidated income statement. Number 1, when you aggregate the revenues and expense, please remember to look at the date of acquisition, because I need to consider the post-acquisition period only. Because out of the current year, we will consolidate only the post-acquisition period. So get that one focus clear. Second, when you consider the sales and purchase, you need to eliminate the intercompany sales. But at the same time, what you need to do, you need to add the stock reserve on the cost of sale. And the figure of stock reserve which you add, it doesn't make a difference. It is upstream or downstream in nature. Reduce the intercompany sale purchase from sales and the cost of goods sold, but add the stock reserve to the cost of goods sold, irrespective up or down. Maybe you can combine them as 2. And the third input, what you need to keep in mind is when you calculate the consolidated income statement, you need to segregate. You need to segregate the profit and loss section between parent NCI. You need to segregate the total comprehensive income between the parent and the NCI. Now, for this particular purpose, when you segregate the profit and loss section, just keep one focus very clear, that the segregation of the profit is not based on the reported profits of the subsidiary. You need to translate the reported profits of the subsidiary in terms of rectified profits of the subsidiary, where there will be 3 key agendas in your mind. Any kind of stock reserve which is upstream in nature, goodwill impairment if the NCI is at a fair value resulting in a full goodwill, and number 3, if there is any fair valuations of the assets taken as a part of the acquisition, and we need to consider any additional depreciation or maybe reverse any excess depreciation. So once you get the rectified profits, you get the share of the NCI in those rectified profits, and you get the parent as a balancing figure. Then when you segregate the total comprehensive income, just add to the NCI the share on the OCI. Holding is going to be taken as a balancing figure. So these are the 3 main crucial points as far as income statement is concerned. So we've tried to capture all the basic nitty-gritties, the technical nitty-gritties at this stage. I didn't do much questions because I think one class is too less to do questions with you. This is just a gist of all the technical issues. For detailed lectures on consolidations, you can watch out the videos in the previous session. And this was a crux which will just, tell you the most crucial points to be kept in mind. So we've got another session which will be on Tuesday, and that is for the other consolidation standards like Ind AS 111, Ind AS 28, and a bit on 27. So in that particular case, we're going to cover the remaining standards, and that will wind up the areas in terms of all the business combinations and the consolidation standards. So I hope that helps. Let me still ask if you've got any further questions to ask. Otherwise, I think our journey for the day comes to an end. So any further questions, please go ahead.
So is it possible for you to make a chart of investment you might be having, a simplified chart to compile the investment definition and that?
Compile the investment, which one?
Investment entity, definition of investment entity.
Okay.
A simplified chart.
Okay, you mean to say these 7 parameters, is it?
Yeah, you might have drawn a beautiful chart of it, right?
Okay, I'll just quickly give you the 7 parameters. Number 1, you need to consider that the objective of the investment, the purpose of this investment, is in terms of either getting a capital appreciation, I'll put it as CA, capital appreciation, or getting a return in the form of interest and dividends. I would say one other parameter is in terms of that you've got more than one investment. And number three, you've got more than one investor who gave you money. We need to see that these investors are unrelated in terms of things. They're not related. Number five, we must have an exit policy, that the money which you've invested has got an exit policy as well. So these are the main parameters. I think there are one or more too, but I don't remember it immediately right now. But if you look at the study material, also what they've done, they've given the investment entity and then they started discussing all 7 parameters, one by one. So this is the main parameters I remember, out of which this is one of the most important parameters on which an illustration is given. So what I remember is 3 definition and 4 characteristics. These which I've given you are the 4 characteristics. Apart from this, there are 2 more inputs on the definition, which is very apparently given. That's what I quickly remember. I am not remembering the 2 definition characteristics right away at this stage. I hope this helps.
Surely. All the criteria must be fulfilled, right?
Yes. But having said that, it could be a subjective assessment that even if you don't meet, let's say there is only a single investor or a single investment, it does not mean that it may not fulfill the criteria. But per se, yes, you need to meet all 7. Any one fails, it's not an investment entity. Correct.
Okay. Thank you.
You're welcome. Okay, so I think on that end, I think our journey for the day comes to an end. So I'm going to see you next on Tuesday with the remaining standards on a consolidation. So enjoy your weekend. See you on Tuesday. Thank you. Bye-bye and take care.